you're applying for, you can service this debt through your income. So they want to make sure that you have enough income to service the debt. But it all depends on what is it that you're applying for. Line of credit could be used for many different things. Sometimes it could be used to help part down payment for a home. It could be help to pay down other high interest rate debt, or it could be just used as an emergency fund. So really it all depends on what the purpose is. That will help determine what limit you can get.
Okay, so let's say, for example, someone is looking to get a line of credit, whether like to either buy a car or like get a place, or they're going to want to go into a business. Do they need to state that reason for when they apply that for the bank? And sometimes, let's say if someone is applying for some, they want to, let's say, get a line of credit for like, let's say 50,000, but they can only qualify for like 10,000. Is it better like to go into more than one bank and get more than one of line of credit in order to be able to achieve what they're looking for?
Yeah, you want to also be careful with pulling your credit so much at different banks, because every time you pull your credit, it brings your credit score down, and it appears on your credit score that you've pulled your credit at a certain institution. So if you pull your credit at different institutions many times, it may pull your credit, or it may cause a red flag that you're applying at different places. So ideally speaking, you just want to understand, or make the person understand, what is it that you're applying for. If it's for a business, that's a very good case. We try to understand what business you're getting into, and we try and make a business case of why you need a higher line of credit. A line of credits could be very beneficial because most of them are interest-only payments. So you're only required to make interest payments. So if you guys are familiar with loans, mortgages, you have to make payments to pay it down, principal and interest. With lines of credit, most of them, you only have to pay the interest. So if you're getting into a business, cash flow may be a little bit tight in the beginning, lines of credit would be perfect for that, because you only have to satisfy the interest portion, and you don't have to really pay it down until you really want to.
All right, yeah, I can see here someone already posted a question here. It says, how do I improve my credit score, and does it help if I have more than one credit card with more than one bank?
That's a very good question. So credit card debt in itself, like credit card limits in itself, is not a bad thing. So what brings your credit score down is a couple of things. Too many credit checks. So you're going to different banks trying to get credit approved, or pulling your credit unnecessarily too many times. And the second thing is actually not having too many cards, but it's being very close to the limit. Meaning, if you have a $5,000 limit, you never want to be owing more than 50% of the balance. So you never want to be at $3,000 or $4,000, because that is something that banks refer to as high debt utilization. So it looks to the bank as if you are needing this debt to meet your obligations every month. So that doesn't look good from a banking perspective. But if you have like a $10,000 limit, and 5 cards at $10,000 limits, and you're only using 1,000 or 2, and you're paying it off regularly, that's actually very good for your credit, because it shows the bank that you have a lot of limits, but you're not utilizing a lot of it. So that means you're not dependent on credit. So that actually helps your credit score. Another thing I always recommend to everyone is set up your payments for pre-authorized. So don't rely on your memory to pay your debt, because we're all busy. It's just not practical for us to remember every single payment that we have with everything else that's going on in life. So I always recommend to clients, always set up your whatever credit card, line of credit, mortgage is automatically done for pre-authorized payments. That way, you never ever have to worry about a missed payment. And I think if you do these 3 things, credit score will come back very quickly. Usually takes about, if you do these things, regular pre-authorized payments, no high debt utilization, and not too many credit checks, within 6 months, it really starts to improve. And some banks actually have have a way where you actually could check your credit score online for free. So I recommend that you also monitor your progress every 6 months and see how you're doing.
Okay, all right. So I think we have covered that question. Now questions are starting to come in. So let's mark this as answered. So the next one, it says, if you have a significant amount of money in your checking account, would you recommend transferring a significant portion to another type of account?
Yeah, so it all depends on, we always say purpose, like what is this money for? If you're just ordering cash in your account and there's really no purpose for it, or you're not really sure what you're going to need the money for, we always recommend something short term like a GIC or something like that if you're planning on using this money, say for a down payment, or you have a major expense coming up. If you're saving towards a goal, if you're saving towards retirement, if you're saving towards possibly making a big purchase, but it's down the road, depending on your tax situation, we recommend either RSPs or tax-free saving accounts. They're both great options, but they're not for everybody. And I'll try and simplify this, if your income today is higher than it's going to be in the future, then RSPs is a great option. So for example, if you're expected to make if you're making $100,000 today, and in retirement, you're going to be making $50,000, then RSPs is a great option, because the money that you put into RSPs, you're not paying taxes on it. The government is not taxing you on it. You only pay tax on it when you pull it out in retirement. So you're saying to the government, don't tax me on it today at 47%, but tax me on it later when I take it out at 20%. So you're obviously saving 27 cents on every dollar that you put into RSPs. If your income is not very high today, where it's going to be in the future, tax-free savings account is a phenomenal approach, because you're allowed to put in up to $69,000 up until this year. So retroactively, you can go back since 2009 or since the year you turned 18. And any money that you make in your tax-free savings account, when you pull it out, you don't pay any tax on it. So it's a great savings vehicle. So again, it's a tax conversation, which vehicle is better, but definitely it would be RSPs or tax-free. I would not recommend you leave money just sitting there. 100%.
Okay, sounds good. Thank you very much. Okay, let's mark this one as answered. So the next one, which says, with the TFSA, do you recommend the day-to-day stock trading, or dividends, or mutual funds, or a mix of all?
So tax-free, it's a great question. Tax-free savings account is where you want to have your most aggressive investments, because like I said, all the gains there are tax-free. So it doesn't make any sense for you to put money in your tax-free savings account for it to just sit in cash or a GIC, because really it's not growing. So again, assuming you don't need the money short term, this money is long term, I would recommend, depending on your investment knowledge, if you're a stock trader, stocks would be great for a tax-free savings account. Dividend stocks may not have as much of a growth potential as just regular growth stocks. So maybe just a stock portfolio, depending on what your need is. Mutual funds is great for someone who wants to start somewhere but doesn't know how to start. Mutual funds offer a basket of stocks that are managed. Or of course, you could do a mix of all. It all depends on what your investment knowledge is and what is it that you're looking for. So there is no right or wrong answer. It all just depends on your personal circumstances and what you're looking for. But great question. You want to have your most aggressive investments in your TFSA.
All right, so sort of like a follow-up question on that. So like, do you need to have like an accountant or someone like professional in order so they can analyze your financial situation, and then they can find the best possible options for you?
Financial planner. I think a financial planner could take care of this for you. Again, you could assess what your tax situation is depending on your income, and then they could advise accordingly whether it makes more sense to go RSPs or tax-free savings account. But again, any money that you put into your TFSA and you decide to invest, you can always pull out at any point in time. And throw in your RSPs. So you don't have to dwell on making that decision, even if the strategy down the road becomes to move to RSPs. But if you put money into RSPs and you pull it out now, you pay tax on it. So that's the difference between RSPs and tax-free savings account.
All right. Thank you. All right. So the next one, it says, should we buy a condo simply to rent it out, or is it beneficial?
So again, another great question. Everybody needs to save towards retirement. What's available to everyone in retirement who doesn't have a company pension is something called CPP, Canada Pension Plan, and Old Age Security. Canada Pension Plan starts at 65. The government gives you about $19,000. That's the maximum you can get. And Old Age Security starts at 65 as well, and the government gives you about $7,000. So if you don't have any meaningful savings and you retire and you don't have a company pension, you've been self-employed all your life, you're getting $20,000 from the government. That's all you're getting. So obviously we recommend to clients through a retirement plan that they need to invest in their retirement. How do they invest in retirement? Tax-free savings account, RSPs, or a rental property where you have a renter that's paying down your mortgage. So that becomes an asset that's hopefully free and clear by the time you retire. So your RSPs, your tax-free savings account, your hopefully paid off condo or two now become your retirement pool that you can draw money from to help out on top of your CPP and old age security that you're getting. So I think it's a great idea. But just keep in mind that most properties now, if you get a mortgage, the rent will not fully cover the mortgage. So you want to understand what expenses are involved in renting the property and what's the deficit between your mortgage payment and the rent, and if you can cover it on month to month, so it doesn't become a burden on you.
So yeah, I also have a follow-up question on that. Like, do you expect, like now currently within the pandemic that we're living in, that the mortgage prices and rent prices will be affected? They're going to go down by it, or we haven't heard any kind of that expectations so far?
So to be honest with you, we thought real estate should pull back because of the job losses and the pandemic that we're in right now. We're seeing the opposite right now. We're seeing real estate move very fast. We're seeing a lot of transactions happen, and we're seeing prices stabilize. Couple of reasons. Interest rates are super low right now. We could probably get a mortgage rate under 2% today. And there's a lot of pent-up demand. People were sitting on cash, and people are now looking and saying, hey, this is a good investment opportunity given the low interest rates. And the Bank of Canada just came up today and said they're not going to be raising interest rates for the next couple of years. So all this is helping real estate sort of stabilize and grow steadily. We could see a pullback in the fall or in the winter, but it's not major. But for someone who's investing long-term, this is not really a significant issue.
Okay, then. Thank you. All right, so next question. Which website do you recommend to check for a credit score? I think you already mentioned, but if you can say it again in details, that would be great.
Yeah, I mean, like I said, I know CIBC mobile app. I don't know about other banks, to be honest with you. But if you have a CIBC mobile app, you can go on the left, just the left tab. There's a section called Check Credit Score, and I think it will allow you to pull it once every 3 months. The nice thing about it, it's a self-check, meaning when you check your own credit, it's actually not a hit to your credit, so it doesn't impact your credit negatively. So that's why I encourage you to continuously monitor your credit and see how you're progressing. But there's a website called Equifax. I think that's one of the most popular ones to check your credit.
All right, thank you very much for that. So 3 questions left here. Next one, it says, how one can get out of debt without declaring bankruptcy. Let's assume a person with a debt of 50,000 Canadian dollars. What about debt consolidation?
I think debt consolidation is the right approach. You want to sit down with a financial advisor to help you restructure your debt. So you may have a lot of debt that's on, a bunch of credit cards, maybe a student loan, and you're sort of chasing here and there to try and make the payments. I think looking at putting it all together into one loan that's hopefully with an interest rate that's lower than all your other debts on a fixed payment plan of say 5 years or 6 years or 7 years, maybe the quickest way to get out of debt. And that is the right approach, because without getting out of debt, you're sort of going to be tied down to actually putting money towards savings. So you want to consolidate everything into one loan, lower interest rate, and a fixed payment plan over a 5 or 6 or 7 year period, depending on your cash flow. And that's usually the quickest way of getting out.
All right then. Okay, so I think the next question also related to it. It says here, what are the consequences of declaring bankruptcy? Like, are they good or bad, or like it depends on the situation?
Yeah, so there's steps before declaring bankruptcy. Usually you go through something called consumer proposal, and then bankruptcy comes later. Consumer proposal, basically you're going to a lawyer who is putting notices to all your creditors, people you owe money to, and he's saying, listen, our client is not in a position to take all these payments. Let's try and come up with some sort of a proposal, maybe cut down the balance in half, third quarter, it all depends on what your situation is. And we will make these payments accordingly. If you default on these payments, then you're forced into bankruptcy. So bankruptcy is a step that comes later after consumer proposal. The impact of a consumer proposal or a bankruptcy is something called R9. So on your credit rating, every line of debt that you owe is rated from R1 to R9. R1 means repayment to AAA. R2 means you've missed a couple of payments. R3 means you've missed 3 months. And R9 means you're wrote off the debt. R9 will stay on your credit for about 6 years. So for 6 years, it's going to be pretty tough to get any sort of credit. And if you do get any sort of credit, the interest rate is going to be sky high, because you're looked at as higher risk than someone else with an R1 or R2. So that I would say these are the consequences, basically. Higher interest rate borrowing and difficulty in borrowing for about 6 years. That's how long it takes to rebuild your.
All right, thank you. Okay, so I see a question just jumped up on here. So it says here, what is the difference between meeting with a financial planner through my bank and hiring a financial planner separately? Is there a big incentive for the bank?
No, I honestly think it's just finding the right person who you trust, who you feel comfortable dealing with, who you can count on advice. I don't really think there's a major difference between dealing with an independent financial advisor or a bank financial advisor, as long as they're a certified financial planner. They have a CFP designation. You know you're dealing with someone who has the highest designation in financial planning and can really look after you in the best way possible. So it's all about just dealing with an accredited financial advisor who's going to give you good advice. Because not every financial planner who has the title of financial planning holds a designation in financial planning. So you just want to be aware of that. That's all.
All right, got it. So I see there's another one here related to it. It says here, what's the difference between an accountant and financial planner, and when does someone get to hire their services?
So an accountant will actually sit there, they'll do your taxes, they'll file your taxes, and they'll try and make you pay as little tax as possible. That could be a good thing sometimes, and other times it's not a good thing. And we can get into the details of that later. But really, that's what an accountant does. He'll recommend some tax strategies and he'll file your taxes. A financial planner will look at your financial situation holistically. They'll look at everything. They'll look at your income, they'll look at your credit situation, they look at your retirement, they look at your investment plan, and with all that in mind, they can make tax strategy recommendations. So think of a financial planner as a family physician and an accountant as a specialist. But one thing a financial planner will not do is file your taxes. They won't do that because they're not accountants, but they're qualified to give you advice on the accounting side of things because they have the full picture. So they work in conjunction with your accountant, I would say. They work independently.
All right, thank you very much. Okay, and question here, it says, what's the best and fastest way to make money on a short term? And what are the best type of business do you recommend investing in?
The best and fastest way is the lottery. I don't know. You know what? It's a tough one. I don't think it all depends on when you're getting in the market. Like I think if people had invested into the stock market when this whole pandemic was starting, when the stock market had dipped about 40%, I think if anybody had bought some stocks or even an investment portfolio of some sort, they would have probably been up short term 30%. So it all depends on your entry point in the stock market or in the real estate market. That usually determines your immediate gain, whether it's a gain or a loss. Yeah, it just all depends on your entry point. What types of business I recommend? Like right now, if you're talking about the stock market, we're seeing a lot of growth in technology and pharmaceuticals. Technology obviously for the remote reasons of us working on Zoom and on other ways of doing business. I think there's been a lot of focus in companies rerouting their employees to work from home. So any software related companies, remote payment programs, Amazon, all these companies have been true beneficiaries of this COVID situation, of course, because of all the ongoing trials to find a vaccine. So these are the two sectors we're seeing a lot of growth in.
All right, so mark this one as answered. Next one, it says, do I need to buy insurance protection from the bank on my accounts, and what's their benefits?
Insurance recommendation is really just a part of your wealth protection. If you're a breadwinner and you have a big mortgage, you do want to insure that mortgage just in case, God forbid, something happens to you. You're not leaving your beneficiaries scrambling, trying to figure out what to do. So it all depends on your credit situation. Usually, if you have a business with some debt or a business that needs some sort of insurance in case the owner of the business, something happens to him, that's where we recommend insurance. But definitely, if you have a mortgage, a big mortgage, you've got young kids, you're the breadwinner, that's where we recommend you have some sort of protection that can be done through the bank or through just a term insurance policy outside the bank.
So I have a follow-up question on that. So let's say if someone hacks the account and does transaction without me knowing, would it make a difference if I have insurance or if I don't have insurance on my account? Or shouldn't either way?
Most banks, most banks will not hold you liable if you've been a victim of some sort of fraud, as long as you were not the one voluntarily giving your bank information to someone. As long as you were just a victim, most banks will take care of it for you, whether it's on your credit card or your debit card or any other route. So you wouldn't have to worry about that.
All right, thank you very much. Okay, a couple of questions just emerged here. So this one, it says, if I bank with TD and meet with a financial planner, can they pull info from Manulife for X where I have RRSP invested and advise me if there is different sources?
So usually we won't have access to anything outside of the CIBC world. So when we're sitting down with a client for the first time, we're asking them to bring us investment statements that are outside of the the bank we work for, just so that we can understand clearly how they're invested and give them a second opinion on what they hold. But we wouldn't just have access to everything else, just for privacy reasons. We're separated.
All right. And this last question for so far. If I win the lottery, what would be the best strategies to take so I can maintain my money and invest in the best way possible?
But I think diversification. Like I think just not putting all your eggs in one basket, whether it's real estate or stock market or or whatever else it may be. I think it's just holding a good balance in your portfolio between investments and real estate. I think you want to diversify your overall net worth and not have everything into one basket. That would just be my recommendation.
Like probably at some point you have to hire like an accountant and a financial planner, like a lawyer, and all those kind of professional people that be able to help you maintain that kind of big money. I'm assuming, is that correct?
Yeah. Yeah.
Okay.
Yeah.
All right. Oh, so another question popped up, so let's mark this one as answered. And if you miss a credit card payment by accident here and there, how drastically does it affect your credit?
If it's happening here and there, I don't know what you mean by here and there. Like, how often is that? If it's happening every other month or maybe 3 or 4 times a year, it may really impact your credit, because banks usually have a screenshot of your history repayment on your credit card, and that usually comes up if you're trying to apply for an increase. So I think the best solution to that is to just set it up on pre-authorized payment so that it's automatically coming out of your account. You don't have to worry about something.
All right. Okay. Thank you very much. And I think if there aren't any more questions, then this was the last question that we have covered here. So I don't know if anyone else wants to send a question, they can still use this link here or send it through the chat. But yeah, thank you very much, David, for covering those questions here that we had so far. Do you have any kind of business or financial advices that you can give us during this pandemic that we can go through to give us the best?
I would definitely say this is the time where you reassess your rainy day fund, and making sure that you always have a plan B for whatever situation that does come up. I think you want to revisit your cash flow, and I think you want to make sure, the one advice I give to everybody is make sure you're set up on what we call a regular investment plan. So you should never have in your checking account more than a couple of grand, and in your savings account no more than 6 months of emergency spending, just in case you don't have a, God forbid, in case you don't have a job for 6 months. You want to have 6 months living expense in your savings account. Anything above that should be automatically invested in some sort of a TFSA or an RSP, depending on your tax situation. And every month you should have a savings plan leaving your bank account going into one of these investments, because if the money sits in the bank account, it's going to get spent. That's usually what we see with a lot of clients. When that money's not in their bank account, they're more disciplined when it comes into their spending habits. So that's the one thing I recommend. Always pay yourself first. And when you start young, you could go on an investment calculator online and just look at the impact of $100 a month over 25 years, growing at 6 or 7%. You'll be shocked with how much money you would have in 25 years. So I think there's not an amount that's too little. Even if you start with $25, you start somewhere and you build up on that. But that's the one thing I hope you guys will take away from today.
Thank you very much, David. I think, yeah, there is another question that came up here, so we'll give it a chance here. It says, would you advise those who with student loans to begin investing, and how does that impact payback on the loan?
Yeah, it's another great question. You want to look at the interest on your loan, and you want to look at the return on your investments. If you think you can achieve a higher rate of return on your investments versus the loan, then there's no rush in paying down a loan, especially when it's a student loan where you can write off the interest. So if the interest cost of the loan is maybe 3% and you're writing off the interest, so you're getting back some money, so the cost is really 2.5%, and you're investing into something that's growing at 6-7% rate of return, then you're obviously winning on that side. But if money's just sitting in a bank account and not doing anything, then obviously you want to use that to pay down debt. So it all depends on what you're doing with that money.
David, how much would you recommend to put as savings out of your monthly salary?
So it's a good question, Miriam. Like it's a cash flow conversation. So, you sit down, you do a quick cash flow exercise. I have $1,000 coming into my coming into my account, hypothetically, $1,000 coming into my account every month. My expenses are $500. So I have $500 surplus.
Okay.
That whole $500 surplus should be going into my savings. Obviously, taking in consideration entertainment and other things and things that do come up. But I don't think you should leave any excess in your checking account.
Okay, you're putting about 50%.
Well, again, it all depends. Not everyone has 50% surplus. Some people may have high expenses; they only have $200. They may only have 100. They may have 50. It all depends on what your cash flow is. But whatever cash flow you have, I think should hide.
Okay, thank you, David.
You're welcome.
All right, I think we have finished all those questions here. All right, if there's anything else that you want to say, Mariam?
David, I would like
over.
again, sorry, can you say the a little biography, because it wasn't recorded at the beginning, so if you can re-say it again, so we have it.
Sure. So again, I work for a division within CIBC called Imperial Service. So I am a certified financial planner. I look after 200 families, mainly high net worth clients, physicians, business owners, pharmacists, clients who are in need of a financial plan. So we do retirement planning, investment planning, kids education, wills and estate, some tax strategies. So it's a holistic approach towards financial planning. So we take the time to understand what the client goals and needs are. And based on these goals and needs, we put together a full written financial plan to address their needs. And what we do is it's an ongoing process. So every 6 months, we'll meet with our clients just to make sure they're on track to achieving their plans. And if there's any changes to their circumstances, we will tweak our plan accordingly to make sure that it still fits their needs. That's it in a nutshell.
Thank you so much, David.
My pleasure. Thanks so much for having me.
It's our pleasure. And God willing, guys, next week we'll be having Abuna Musa Makram from Long Island. And he will be talking to us. We'll be continuing again the prayer series, and he'll be talking about Nehemiah 9. So if you want to read ahead, so you're ready if you have questions, or if you want any meditations to think about it for next week, that will be great. And let's see what happens with phase 3, with the opening.
Yeah, I'm so excited for it.
Yep. Let's hope we can do something next week. We'll see.
All right. Okay, we can end it with a prayer.
Yes.
Right.
Amir, you can go ahead and pray. In the name of the Father, and the Son, and the Holy Spirit, one God, Amen. Thank you, dear Lord, for this lovely meeting, and we hope that we all did benefit. Hear us, O God, when we pray thankfully. Our Father, who art in heaven, hallowed be thy name. Thy kingdom come, thy will be done on earth. Through the intercessions of the Mother of God, Saint Mary, and all of the saints, hear our prayers, O Lord. Thank you guys for being here, and wait for the next email, and let's pray we can hopefully meet or something.
Yeah.
We'll see.
Thank you very much. All right. See you next time.
See you next week.
All right.
Thank
bye-bye.
you so much. Thanks, David. Bye.
I'm happy.
Thank you, Dave.
Thank you, guys. Mariam, have a good night.
You too, Malako. Have
Thank
a
you,
good
Malaka.
night.
Good night.
Good night.
All right.
Good
Take
night,
care,
Angie.
everyone.
Bye.
Thank you.